You're listening to the Learn Like a CPA podcast, where we talk about all things real estate, tax strategy, and personal finance. Whether you're a real estate investor looking to scale your portfolio, or you're an individual wanting to take your financial freedom journey to the next level, this is a podcast for you. Welcome back, everyone, to the Learn Like a CPA podcast. Today, we're going to be talking about short-term rentals in particular, as well as the short-term rental loophole. And we're also going to dive into a case study from a recent client. So why invest in short-term rentals? Well, there's more cash flow in short-term rentals than there are long-term rentals. Let's just be honest. If you've been investing in long-term rentals, multifamily, single-family houses, you know that there's more cash flow to be had in short-term rentals than there are long-term rentals. There's easier financing options in short-term rentals in most cases, where you're able to take out a 10% down secondary home loan that's going to have a lower interest rate, more favorable terms to buy compared to if you were to buy any other multifamily or single-family house with a conventional loan. You're looking at 20 to 25% down. Whereas short-term rentals, easier financing options. Most of the time you can get them for 10% down, 15% down. You're a rental host, you're a guest, you're a host, not a landlord. And for me, this is one of the things where I hate being referred to as a landlord. I'd much rather be referred to as a host. And in the case of owning short-term rentals, you're referred to as a host rather than a landlord. Even though at the end of the day, you're still making money from your rental real estate, you're referred to as a host, as a landlord, which is something, as I own multifamily house, it makes me feel a little bit better about myself. I don't know about you guys, but it's a place to stay and go on vacation, right? At the end of the day, we want to take our families out, enjoy ourselves, set up short-term rentals in each place we'd like to vacation at. So I might have a short-term rental in Florida, might have one in California, the Smoky Mountains, North Carolina. Set up short-term rentals in areas where I actually want to bring my family or get away for a while, right? And it's a place to stay and have a vacation. Last is the major, amazing tax benefits that not only come with having rental real estate, but in specific short-term rentals. And what's known as the short-term rental loophole that I and a lot of other CPAs and tax advisors have been talking about. And in order to understand the short-term rental loophole and why it's really a loophole, first we have to understand that it's a paper loss. Okay, so we're still making cash flow from our rental real estate, but because of the tax code and the way that it's set up, we're able to tell the IRS that we essentially didn't make any money. So we're making cash flow, we're bringing in profits, but we get to tell them that, hey, I actually didn't make money. I actually had a loss on paper. And you'll learn a little bit more through other content about how to create this loss and the depreciation and other expenses that you can take. But that's the gist of it. So we're cash flow positive, but we're getting to turn around and tell the IRS that we had a loss. And in order to appreciate the short-term rental loophole in particular, you have to understand why they're different from long-term rentals or multifamily or other forms of real estate investments. And to understand that, we have to go way back before 1986. So from 1913, early 1900s, when the tax code was invented, until 1986, it was almost like the wild, wild west of the tax code. It was like free roam, because all income that you made, whether it was from W-2, maybe you owned a business, you had stocks, real estate, all income before 1986 was considered one type of income. It was all lumped together. So it didn't matter what type of income it was all treated the same for tax purposes. This created a problem, because you could have a high-earning professional, and the joke used to be, two doctors get together to buy real estate. What do you call it? It's a tax shelter, because they're able to make $500,000, $600,000 as a W-2, buy a bunch of rental real estate, depreciate it, take expenses against it, and create losses and offset their high doctor, dentist, physician salaries. And it wasn't until 1986 where Congress did a mass tax overhaul where they essentially plugged this. They figured this out, and they said, hey, now there's going to be two different buckets of income. You're going to have non-passive income, which is going to be W-2, 1099s, retirement income, stock income, gambling income, whatever it is, you name it, non-passive income. And then there's going to be another bucket that's considered passive income. And so passive income is two things. By default, all rental real estate. So short-term rentals, long-term rentals, single family, multifamily, whatever it is, commercial, passive income through real estate by default. The other form of passive income is any activity in which you don't materially participate in. So I could own a percentage of a hair salon or a laundromat, any sort of business or an investment, any sort of business that I invest in, but I actually don't make management decisions, is going to be considered a passive activity. And so what happened then is now there's a plug for this, right? Because I cannot, as a doctor, take my rental losses and offset my doctor's salary anymore. These losses, they're in two different buckets, passive, non-passive, and they're separate. I cannot use the passive losses to offset the non-passive income. And this happened for about 7 years. And then in 1993, real estate professionals, people who are in real estate full time, they kind of had enough of it. And they said, well, hey, wait a second. We're not abusing the tax code here. We're not trying to take advantage of something. We're just real estate professionals. We invest in real estate. We have real estate for our day job. Cut us a break here. And that's when Congress came out with what's called real estate professional status. So real estate professional status is something where you have to work a ton of time in a real property trade or business for your day job and also invest in real estate, rental real estate on the side in order to take your losses against your income. So what does that look like, right? I might be a fix and flipper. I might be a wholesaler, a real estate agent. Maybe I own a brokerage firm, but I also invest in real estate on my own, rental real estate. And they would let real estate professionals take losses against their income. Okay, very powerful tool, because if I'm able to, again, generate cash flow positive, but show a tax loss, I'm able to not only offset my rental income, but that loss that I'm able to show, I'm actually able to use that loss to offset my W-2 income, my 1099 income, other income that is non-passive. In order to qualify as a real estate professional, you have to spend, number one is more than half your working time has to be spent in a real property trade or business, which means if I'm an accountant, if I work 2,000 hours at my CPA firm, I would have to spend 2,001 hours in real estate. Impossible to do. Sometimes I do work 80-hour weeks, but I'm not working 80-hour weeks every single week out of the year. And if you have a full-time job, a W-2, in a non-real estate field, if you have a full-time W-2 in a non-real estate field, there's no way you're going to qualify as a real estate professional, because you would have to spend more time outside of your day job in real estate than your primary job. The second part is 750 hours, right? You have to spend 750 hours in real property trades or businesses. So these tests, if you can meet it, real estate professional status is an absolute gem, because you're able to have your brokerage, your fix and flips, your wholesaling, your real estate agent business generate losses from your rental properties and pay no taxes in the end, right? But it's very hard to do, because you have to be a real estate professional. You have to have that as your day job. So the reason short-term rentals are different than, say, long-term rentals or commercial buildings is you don't actually have to be a real estate professional in order to take the losses from the short-term rentals against your non-passive income. You just have to prove that the average guest stays 7 days or less in your property, so Airbnb or Vrbo. So you would add up the total amount of days that it was rented, divided by the number of stays, and if it's 7.0 or less, you're good to go on that part. The other qualification test is you have to materially participate. Now, I've spoken about material participation on a few other podcasts and episodes. Material participation, to sum it up, is time spent managing that rental property. So if your time spent staging it, maybe you're coordinating with guests, doing the communications, those hours are going to count for material participation. And you need a certain amount of these hours per year in order to qualify. So you're not going to be able to buy a short-term rental, hand it off to a property management company or a team, and qualify for this. You actually have to spend some time working in the property, which bodes well for people who buy short-term rentals. Maybe they have to do a little bit of staging, or maybe it was a single-family residence that's now converted to a short-term rental. They're going to get their hours from the staging time, from the development time, from coordinating with guests. It's not too hard to meet the hours requirement. But let's dive a little bit more into the hours requirement. So the first test that I like to recommend to people is the 500-hour test. And I call this one the gold standard, because if you can prove 500 hours, you don't have to keep track of anybody else's time in the property. Why that's important is because the next test is 100 hours and more than anyone else. So I have to spend at least 100 hours and more than anyone else. So if I have a cleaner, a contractor, I have to prove that not only did I spend at least 100 hours, but my time is more than them. So if I spent 110 hours and my contractor spent 80 hours and my cleaner spent 60 hours, I'm good to go. Even though the total of their hours was more than my 110, I only have to beat them out on an individual basis. And if you're worried or wondering about a cleaning company, it is per individual still. So if there's 3 cleaners, you only have to beat out each cleaner's individual hours. What does all this mean, right? These hoops that you have to jump through are very important because we're able to generate non-cash losses, paper losses, and use them to offset our W-2 or non-passive income. So just a ballpark, in a scenario where maybe you have a short-term rental and it's making $50,000 a year net income, okay? But I'm able to generate a $50,000 loss, okay? So I'm not paying taxes on the $50,000 of income, and I'm able to generate a $50,000 loss. So my total savings, if I take $100,000, the $50,000 income, the $50,000 loss, and I use that to offset my tax bracket, if I'm in a 30% tax bracket, well, congratulations, I just saved $30,000 by doing this strategy. And we're going to walk through a case study today. So recently filed a tax return for a client. And to give you a little bit of background, the taxpayer is in a 35% marginal tax bracket. And they live in a high income tax state too, so that's important. The particular client purchased $1.1 million worth of real estate in 2021 and placed it into service. What's important is the client was facing a $140,000 tax bill between federal and state authorities. So they were having to cut a $140,000 check, right, to the government. And we know that the government are not good stewards of our money. We'll leave it at that. The client performed 2 cost segregation studies and hired a competent tax advisor to help walk them through the test and the qualifications and the strategy, right? And so they might have spent $8,000 to $10,000 a year to hire people to provide strategy for them, the cost segregation firms, the advisors. They might have spent 10 grand doing so. But because of the strategy, instead of sending a $140,000 check to the government, the client's actually getting a $20,000 refund through the cost segregation, through the tax strategy, through the material participation test. They're actually getting a $20,000 refund. So you can imagine the expression or the feedback from the client. Instead of facing a $140,000 tax bill to Uncle Sam, you're actually going to get $20,000 back from Uncle Sam. So a total tax savings of $160,000 for this particular client. And to kind of break down what that means, right? That's $160,000 that instead of handing it over to the government, I'm able to employ in my business, or in my rental properties, in my business activity, whatever it is I'm doing, my investing journey. That $160,000, instead of just poof, gone to Uncle Sam, I'm able to make that money work for me. And I kind of ran out some numbers here of just what $160,000 in savings today means for the person. If I take that $160,000 and what could it grow to, right? If I took that $160,000 that I saved from the government, not having to pay the government, at an 8% growth rate over 10 years, that $160,000 turns into $345,000. That's from a stock market index fund perspective. What if I was able to achieve a 20% cash on cash return on my $160,000 of tax savings though? What if I took that $160,000, employed it into more rental real estate, so I'm able to get more appreciation, more tax benefits, save more in taxes, right? But what if I'm able to get a 20% return, 20% cash on cash return just on $160,000? So the next year I have 20% more. The year after that I have 20% more. That $160,000 in 10 years grows into $990,000. And this is just from a cash on cash perspective. This doesn't factor in inflation hedge, appreciation, tax benefits, equity pay down, tax benefits, right? So this $160,000 in tax savings could easily amount to $1 million in a year. So when you're talking about breaking generational curses of maybe poverty or wherever the background you come from, or hey, you want to be that person that changes your family tree. That's why tax planning is so important, because hey, we're saving money today that we're able to invest and let it grow for us over multiple years, that we're able to take and turn it into more money. So instead of handing a check to the government, we're able to take that money, save it, and invest it and let it grow for us. So some action items for you today is you got to assess your situation. Are you a high W-2 earner? Maybe you have a profitable business. You got capital gains coming in. You got these deals that are going to go through. Or you want to just change your family tree and you want to learn how to build massive amounts of wealth through rental real estate, specifically short-term rentals. Assess your situation, figure out where you're at. And it's better to do this throughout the year than to wait until after the year's over and then try to plan. After the year's over, there's little to nothing that you can do from a tax perspective to help your situation, because the year's already over. There's nothing you can do. The calendar year is from January 1st to December 31st. So only those actions that you do between those dates are actually going to save you money in taxes, right? You have to have a passion for rental real estate, and you need to know what moves to make. You need to surround yourself with those mentors, with those people in the field, the mastermind groups, the productivity groups, the people that are going to lead you, not just show you, but almost lead you into where you want to be. And it's not hand-holding, but it's more so, hey, this person has been there before, done that, and they're willing to offer advice to you. So whether that's a friend that's done it before, or if you have to pay for a group or pay for a mastermind, it's money well spent. And lastly, hire competent professionals to help you, to guide you through these transactions. You're going to save more money working with competent professionals than you are having to pay government bodies or authorities. And you're going to save more money in the long term. That's it for today's episode, guys, about short-term rentals, the short-term rental loophole, and real estate in general. If you want to leave a comment or have a question, leave it below or shoot me a message on Instagram and Twitter @LearnLikeACPA, and maybe we'll cover it in the next episode. Thanks so much, guys.